So the functions of money are up there. Who can tell me what it means for something to be a medium of exchange? Anybody? What are some characteristics of a good medium of exchange?
Everyone wants it.
Everyone wants it, right? So it's got a value, right, of some kind. It's valuable for some reason, right? Whether that be because it legally has to be valuable or because it's made of something that people consider to be valuable, right? Like gold. So that's what we call commodity money. But anyway, yeah, so medium of exchange, right? It has to be generally acceptable, right? What else? What's another characteristic of like money that you might want?
Like easy to carry around.
Easy to carry around, right?
Can't be
Convenient to
cows.
use. We'll talk about commodity money in a second, but that's really what we're talking about, right? Like it has to have a high weight to value ratio. And again, nowadays that's not so important, but like when money was first being used in the way it is today, it wasn't. Anything else? A couple other things. You got two of them. That's pretty good. Has to be divisible, right? Has to be in like low enough denominations. Ooh, pardon me. Has to be in like low enough denominations so that like you could buy something that costs like 5 cents, for instance, right? If everything's priced, if the lowest you can get is like $1, then all of a sudden everything has to be priced in dollars, and that makes things a little inconvenient, right? And that has to be non-counterfeitable, right? So that one's pretty self-explanatory. All right, store of value. What are the characteristics of a good store of value? If you have the G book open, you can pretty much just tell me what's on the G book. But
Like your earning and like the earning and the spending isn't synchronized.
yeah, that's what it says in the G book. But that's sort of like the problem that stores of wealth solve, right? So the problem that a medium of exchange solved is that if you don't have money, right, you have to barter. And barter requires something called the double coincidence of wants, which is like, if I'm, let's say I'm a carpenter, all I make is chairs and things out of wood, and that's all I have to give in return for something, right? And so if I want to go to the butcher and get some meat to eat, I have to hope he's willing to accept whatever I happen to be producing, right? That's what we call the double coincidence of wants. So having a medium of exchange allows you to not have to rely on that double coincidence of wants, and it allows you to specialize in what you do best, right? Instead of having to provide everything for yourself, you can focus on being a carpenter and get better at that over time, and overall we all have gains from that. Does that make sense? So that's the problem that sort of medium of exchange solves. The problem that a store of value solves is precisely that the day I make a chair might not be the day I need to go to the butcher and eat, right? So maybe I want something that I can store the value of my labor in until a later date when I need to consume it. So that's what we mean by a store of value. But what would you like to see in a store of value, right? Think of some things that you could do with your money. Think of some things that you could buy with your money to store its value until a later date. What's the characteristic you might like that asset to have?
It shouldn't decrease over time.
It shouldn't decrease, it should probably be stable, right? You're probably not gonna be too mad if it increases, but yeah, it at least shouldn't decrease over time. We want it to have stable value.
Gold.
Gold is an example, yeah. So, yeah, a good store of value should be stable, and it should, that's basically it, right? It just has to be stable. And again, that's kind of a subjective thing, right? Like, I mean, you look at something like Bitcoin, it's called a cryptocurrency, it's very volatile, right? But some people seem to consider it as a currency. They try to buy goods and services with it. Other people just kind of put their money in it in hopes that it goes up, right? So if you're putting your money in something that in hopes that it goes up, that's not necessarily like a store of value, right? That's more of an investment. You're risking your money in order to get a return, right? Which is kind of not the spirit of a store of value, which is kind of implying that it's like risk-free, right? And then the third one's maybe a little bit more difficult to understand, but the third function is unit of account, right? So the idea is that money has to be something by which we can compare the value of two different things, right? So if I say I have a chair that's worth $100 and you have 3 pounds of beef that's worth $20, we know which one is worth more. That's basically it, right? We can compare people's preferences by comparing the dollar value of items. So that's what it means to be a unit of account, right? It's basically just like it's the unit you use to calculate value. Does that make sense to everybody? So those are the 3 functions of money. Very important to know about those for this course. But as we know today, right, money doesn't need to be physical. right? Think of like your deposit account, like anything, like your debit card, right? You put money in a debit account, it's a store of value, it's a medium of exchange, right? Because every time you use your debit card, you're not going and getting cash, and then that person takes the cash and puts it in their debit account, right? You're directly transacting between accounts. There's no cash moving around. So that's like just to show that money doesn't need to be physical, right? And most money, in fact, is not physical in this day and age, which we'll talk about when we talk about the different money supplies, right? So let's go back to the origins of money, right? So like, think of like I don't know, you're like in the Indus River Valley and you're one of the earliest civilizations. Everybody started to figure out how to grow crops, right? Society's evolving. People are starting to specialize, right? Maybe one guy decides to be a carpenter, one guy decides to be a farmer, right? That's what we call division of labor. So it's the idea that if you're not having to do if you're not having to be like a jack of all trades and you can rely on other people to make certain things that you need and then exchange with them for them, that's what we call gains from trade, right? Because I can specialize, I can get better, and overall, we produce more. So this exchange starts to take place, right? And originally, the earliest examples we have of this, people are bartering with crops, right? So things like rice and corn, people will exchange with each other, or they'll write each other notes saying, I owe you this much corn, for instance, right? But the problem is that corn's like consumable, right? You want to eat it, like it's not necessarily good for money because there might be a year where like maybe there's a drought or something, right? And all of a sudden all your money disappears. Or you're like, it doesn't really make sense to necessarily be like eating money or consuming it outside of just like using it for transactions, right? So people started to use metallic money, right? To solve that problem with the double coincidence of wants that comes with bartering, right? So people started to think, right, hey, we like this shiny metal, let's make these little coins out of it and we'll exchange those and those will represent value for us, right? And those coins derive their value from what the commodity they were made out of, right? So sometimes it would be like gold coins. I think the earliest ones date back to about 600 BC at this point. Some parts of the world where they're abundant in gold and silver are able to use things like gold or silver, right, which have a high weight to value ratio. Some places in the world, like Scandinavia, there's evidence of them using gigantic copper sheets as coins, right, because they didn't have any value. Like they were trying to trade with other parts of the world, but they didn't have anything that matched the value of silver or gold, right? So that is one coin, that's one like inconvenience, right? It's like you have to physically carry around. Like if you want to make a small transaction, it's okay, but for large transactions, it starts to become physically, like logistically inconvenient to use money, right? To use commodity money. Another huge problem at the time was something we call debasing the currency, right? Or clipping. So these coins are made of gold, and there are a lot of people desperate enough at the time, right? This was a crime punishable by death, but what they would do is they would trim little bits of gold, right? Because the gold itself was valuable. So over time, right, these coins that were in circulation started to get like whittled down into these little nubs. There were also kings at the time, right, like myself, who had a huge incentive, right? Because like at the time we didn't really like understand what it meant to have wealth, right? Like what is money? They just kind of thought like gold is valuable, and if I have a lot of it, then I'm doing well, right? And so there's a huge incentive for kings to extract gold and mint coins regardless of what's actually being made in the economy, right? And there's also a huge incentive for them to maybe mix in things like brass, right? Less expensive metals into these coins. So that's what we call debasing the currency, right? People were like chipping gold off of them. Kings were making them out of like dubious metals that weren't necessarily gold, right? And there are some sort of early, you could call them financiers, I guess, at the time, like John Law was one of them, but that's not this guy. Notice something called Gresham's Law, which is that as there were all these coins that started, like these really bad coins in circulation, people started to hoard the ones that were intact, and they were essentially taken out of circulation, right? And so Gresham's Law is the law that good money, or bad money drives out good. And so that's sort of a motivation we have for trying to fix this, right? Is that it was stifling trade in the economy because there just wasn't enough coinage that was intact, right? So people have all these like coins in different conditions, right? And what they would do, right? They would take them to goldsmiths, right? Most of the time these coins were made of gold, but goldsmiths were people who understood the value of precious metals, right? They had expertise in metallurgy at the time, right? So people would take their coins to goldsmiths to have them assessed, right? They would be like, oh, looks like this one you have is maybe made out of a little bit of brass, or maybe this one only weighs this much as opposed to what it's supposed to weigh, right? And so they'll assess the value of their coins, they'll hold on to it, and in return they give you a note that tells you how much your coin was worth, right? And those are called banknotes, since that's the earliest form of paper money we have, right? That's kind of why we refer to them as banknotes. They used to be given out by goldsmiths, sort of like a pawn shop almost, right? And then those goldsmiths started to realize, like, hey, we give out all these notes, right, which are supposed to be convertible into gold, right? You're supposed to be able to bring those back to a goldsmith and they'll give you a corresponding amount of gold, right? But they started to realize, right, that like, we're taking in a lot, like people don't come to withdraw as often as they come to deposit. And so, like, there's a greed element that comes up, right? But like, it's also, it does represent resources that aren't being put to work in the economy, right? So they started to realize, let's loan out some of the money that we have. And now all of a sudden, the banknotes that are being issued aren't backed one-to-one by gold, right? There's less gold in the vault than there are banknotes in circulation. Does that make sense? Like if everybody came back at once and said, we want our gold, they would not have enough. And so like, you can maybe tell yourself like, yeah, if you're being careful, then maybe you could do this, right? But like, there's not really, it's like the Wild West. Well, it's not literally the Wild West, but like, it's figuratively the Wild West in terms of like the laws that were in place for banks, right? You pretty much do whatever you want, as long as people didn't get so bad they wanted to kill you, right? So that leaves room for a whole lot of shenanigans, I guess you could say, right? So what would happen is like, your banknotes were dependent on like the trust people had in that specific bank, right? And that lasted all the way until the 20th century in the United States, right? Where it's like your bank, you didn't have like United States dollars, you had money that had been issued by your bank specifically, and you had to hope that other people would be willing to accept that, sort of like a personal check, right? Like if some random guy comes up and writes you a personal check, you might say, oh, like what if it bounces, right? It was kind of the same thing, but with your bank. And so eventually there were all these bank runs happening, right? Like people would panic, everybody would go at once to get their money back, the bank would shut down and everybody would lose everything, right? And so the government started to want to take more control, and that's when sort of central banks started to pop up, right? So I guess we're not actually quite there yet. So modern money, right, is fractionally backed, but it's not backed by gold anymore. So I think there's a timeline of this in the G book, actually let me see here. But after World War II, we basically abandoned the gold standard, right? There are certain countries that were so much in debt, right? Think of what the gold standard meant for international trade, right? Like nowadays, if I want to shop for something in the UK, I can just go to a currency exchange and exchange my Canadian dollars for pounds and go shopping in the UK, right? Back then, that meant you had to physically ship gold to the UK, and then once you're there, you can exchange it for the local currency, right? And that's extremely inconvenient, especially during World War II, when there were certain countries which were becoming extremely indebted to others, right? Like the US lent a lot of money to European countries during the war, and those countries were basically running out of gold. Even though the US probably had confidence that over the next like few decades, they'd be paid back, right? If your system relies on gold and you're just out of gold, then like trade comes to a halt, right? So they were forced to basically abandon this, and instead what happened is there was a conference called the Bretton Woods Conference that was held. And a bunch of world leaders came together and decided that each of the currencies would be convertible into the US dollar at whatever value they deemed acceptable, right? So those rates are floating, and then that the US dollar would be convertible into gold at $35 an ounce. So that value was fixed, and then every other currency was backed by the US dollar. And then the Vietnam War happened, there was an OPEC oil crisis in the 70s, and so in 71, Ronald Reagan suspended that convertibility, and it's been that way since. So now, obviously, like what does convertibility of gold mean, right? Like you can obviously still buy gold with money, so it is convertible by gold. It's just not explicitly pegged at $35 US to 1 ounce, right? So maybe, I don't know, whenever there's crisis, you hear a lot of people talking about going back to the gold standard, but then you have to ask yourself, do they really understand what it means for something to be convertible into gold, right? Because you can convert your dollars into gold now. It's just that rate is determined by the market, right? Are there any questions about that so far? It's a lot of history here, and I promise you there will probably be questions about it on midterm too, at least one or two in the multiple choice, right? So in Canada, how it works, so like these private banks, right, like they're doing all right for the economy, right? Like they're helping solve this currency issue, but again, there's a huge incentive misalignment between banks and people, right? Like banks are betting with your money, and so they have an incentive to maybe take more risk than they otherwise would with their own money, right? So part of the way we sort of control that issuance of money by these banks is by introducing a central bank, right? So in Canada, the way that works is the central bank, we have the central bank, which we call the Bank of Canada, and then we have I don't know why it calls them just commercial banks or financial intermediaries. We call them like charter banks usually in Canada. So we have like TD, RBC, Scotiabank, those, right? So let's see what the central bank, so I guess this is history of central bank. That's not super important for now. One thing I think I've gone over before is that the Bank of Canada has considerable autonomy, but the ultimate responsibility for the bank's actions rests with the government. So the government, the way that works in practice is the federal government, like Justin Trudeau, tells the bank, your job is to control inflation, is to keep inflation at 2%. And then the bank has sort of freedom to decide like what interventions it wants to do to achieve that goal, right? So there is kind of like an implicit control that the federal government has over the Bank of Canada, but in sort of the same way that kings have an incentive to like debase their currency and print and mint more coins incessantly, politicians sort of have a huge incentive to print money too, right? So that's kind of the philosophy behind keeping the supply of currency outside of the political cycle, right? Even if you don't want to take a stance on whether we should print a lot of money or not print any money, it is bad to have that fluctuate with the political cycle, right? A conservative gets elected one year, contracts the supply of money, a liberal gets elected the next year, expands the supply of money, right? Just that change is bad, whether or not you think, like, you know what I mean, regardless of the policy. So that's sort of the motivation behind it being separate from the federal government, right? So the three basic functions of the Bank of Canada are its role as banker to the commercial banks, right? So you go deposit your money in a bank, that bank is maybe gonna loan it to people as a mortgage, right? Maybe it's gonna loan some of it to like Apple, whatever. It's not gonna be able to loan all of that. At the end of the day, it still will have some money left over that it wasn't able to do anything with, right? It puts that in its bank account with the Bank of Canada and earns interest on it. So that's one function that the Bank of Canada has, right? It's the banker to the commercial banks, and it will borrow their money for them if they have nothing else to invest it in. So that the cash isn't just sitting there doing nothing. That's kind of the philosophy there. It's also a banker to the federal government, right? So the budget balance, any funds that the federal government receives are kept with the Bank of Canada and earn the policy rates. And then it's also a regulator of the money supply, right? As we'll talk about maybe, hopefully this week you guys are seeing it. We talk about a bunch of different things that the Bank of Canada can do to expand or contract the monetary supply, right? So it can change the interest rate, right? And we'll see in a second how changing the interest rate or the reserve ratio can sort of affect lending and borrowing. Or maybe not the interest rate, because that's monetary policy or theory. This is monetary theory. I think you're doing monetary policy right now. So, but we'll see one way in which it can regulate the money supply. So those are the three things it does. Are there any questions about that? All good? All right, so table, I mean, we'll talk about this in a second. But this is sort of what the balance sheet of the Bank of Canada looks like, right? You can see its assets, so the things that, as a bank, like you can think of it as a company in a way. It is definitely a special company. It's not like any private firm, but it has a balance sheet, right? So they'll do things like buy government bonds in exchange for money. That's one way they exchange they expand the monetary supply, right? Is they loan money to the federal government. I guess in that case, in 2019, they weren't giving advances to commercial banks. Net foreign currency assets just means, is it holding on to any foreign currency, right? If you, let's say my country buys some goods from Japan and gives them Canadian dollars, right? What are you gonna do with Canadian dollars in Japan? You can't buy things with Canadian dollars in Japan, right? So you can try to convert it into local currency, which if you do at a large scale can kind of start to impact exchange markets. Or you can lend it back to the people that just sent it to you, right, and earn interest on it. And that's what most countries choose to do, right? So net foreign currency assets is just like how much of that foreign currency, because of our trading activity, are we holding on to and earning interest on, right? So if it's positive, it means we are a net lender to the rest of the world, and if it's negative, it means we're a net borrower from the rest of the world. Notes in circulation, that's just like the value or the nominal value of cash in circulation. Government of Canada deposits is the amount of money that the Government of Canada has in their account. Deposits of commercial banks, and then other liabilities, right? So we'll talk about this, but like, actually, maybe I'll just show it. I think I have. So basically you can see like, look at this. So you can take a look at the balance sheet of the Bank of Canada. So here, I don't know if that's big enough. So this is telling us, so here are, what we call treasury bills, right, which are basically extremely short-term bonds. So this is basically, this line going up means the government, means the Bank of Canada is expanding the money supply, right? And you can see right around when the pandemic hits in 2020, right, interest rates were rock bottom, which is a form of expansionary monetary policy. And then they start purchasing a bunch of government debt, right? So they start printing new money, creating new money to loan it to the federal government, right? That's what's happening here. You can see the gigantic spike that takes place where the value of the debt they held from the government reached almost $450 million, right? Which is a lot of money. Sorry, that's 450 billion. But we'll talk about that in a second, right? That's not necessarily real, right? That's an unrealized gain. But and then you can see the shorter term debt here goes up and then back down, right? So normal times, if we're to return to normal times, right, you kind of expect that that level has to come down back to where it was pre-pandemic, right? And it's still very slowly coming down. And a lot of that isn't necessarily because the Bank of Canada is able to sell these debts. It's probably because they're just running off, right? Like these ones, the blue line here is what we call treasury bills, which are generally between 1 month and 1 year, right? So those probably just ran out naturally. Whereas these ones, right, it's like they're having to hold on to these bad assets and hope that somebody wants to buy them, or just let them elapse, right? But the point is there's a huge monetary expansion over the course of the pandemic that they're trying to slowly deflate, right? I think, but that's basically the story that's being told by this one, right? Okay. I think I encourage you to go over the example in the G book about money creation, right? What time is it? Okay, maybe we do have time to go through this. So basically the way we create money, right, when we want to increase the monetary supply, we don't actually print new money, right? We don't physically print new money. That's very time consuming. It uses resources which cost money, ironically, right? So what actually happens is we'll use monetary policy to influence the amount that banks are able to loan, right? So if we increase interest rates, people will be less willing to borrow money, right? And that's kind of going to contract the money supply, right? Banks won't be able to create as much by lending. And if we lower interest rates, more people are going to want to borrow, and banks will have an incentive to lend out their cash instead of keeping it, earning a low interest rate with the central bank, right? So we control the amount of money in our economy by controlling the behavior of banks, right? By reining them in or letting them loose, right? So let's assume, right, because we want banks to not fail, we assume like, hey, you can't lend out all your money. We're going to say you have to keep at least 20% of the deposits you keep in your vault ready to serve deposit outflows, right? The rest you can invest in whatever you want. You can loan as mortgages, whatever. So let's look at this scenario, right? So let's say we tell TD you have to keep a reserve ratio of 20%. Their balance sheet might look something like this, right? So they've got, people have come and deposited $1,000 in their bank, and then maybe there's $100 of shareholder capital. So maybe the shareholders of the bank have themselves invested $100 in the bank, right? A quick side note, it's kind of outdated to talk about reserve ratios. Now our requirement is actually capital. So instead of requiring them to keep cash in the banks, we require them to basically use a certain percentage of their own money when making loans, right? Not just deposits, to sort of align the risk-taking incentives. So I don't know why they still teach this, to be honest, because the reserve ratio hasn't existed for a very long time. But anyway, it's a good way to maybe start thinking about it. So they have $1,000 of deposits, and we tell them they have to keep 20% of that, right? So obviously they're gonna have $200 of reserves to meet that requirement, and they're gonna make $900 of loans, right? They always wanna make as many loans as they can because that means more profit for them, right? If you're a profit maximizing bank, you're gonna try to loan as much cash as you're allowed to loan, right? Or as the economy will accept. So this is our initial situation. Now let's say that somebody comes in and deposits an additional $100 with TD Bank, right? Now, the reserve ratio is too high, right? We've got $300 in reserves, right? We haven't had a chance to lend that money out yet, and our deposits have gone up. So now our reserve ratio is 27%. And your shareholders see this and say, hey, we want to make more money, you better get that back down to 20%, right? Like lend out that extra money that's come in. And so what they're going to do is they're going to loan out $80, so now they're back at the 20% reserve requirement, and they've increased their loans by $80, right? So they receive $100, they keep 20 of it in reserve, and then they loan out 80, right? But imagine, right, what happens to that $80 after they loan it out, right? Let's say you're a family, or you're an entrepreneur, right? You've come and got a small business loan. You're gonna go, I don't know, buy a conveyor belt to do something with. You're gonna take that $80 and you're gonna either spend it, or you're gonna put it in your bank account, right? If you spend it, then that person's just gonna put it in some other bank account, right? And then that bank is gonna do the exact same thing. They're gonna keep a certain portion of it to keep their reserve ratio, and then they're gonna lend the rest out, right? And that process repeats itself, sort of like it's different than the multiplication process, but it's the same sort of geometric series logic that happens, right? Is that's gonna keep happening. The amount that gets created is gonna get smaller and smaller, and it's gonna converge, right? So, yeah, so you can see this is a second round bank receives $80 in new deposits. It's gonna expand its loan by $64, and then so on and so on, right? So you can see the original $100 is gonna create $100 of deposits. It's gonna create $80 of loans, $64 of loans, $51.20 of loans. We can add all this up, right? So we've only deposited $100, but what's the total that's been created, right? Is we've created $357.07, or we've created $446.33 of money, right? That money is showing up on their TD apps as balance in their accounts, right? It's only backed by $100 in deposits, but we've created $446, right? You can see how crucial it is to carefully manage that, right? Because it's clear that if everybody tries to cash that out at once, then it's all gonna fall apart, right? But that's how we create money, and that's why when we influence the reserve ratio of a bank, or we influence how much they're able to lend, we influence the speed at which money is created. Is that clear to everybody? Any questions about this multiplication process? Yeah?
Could it be like TD and then second round bank also TD but just a different account?
Yeah, absolutely.
Okay, so.
Obviously, they're gonna be keeping track of things like that at the end of the day, but yeah, that could totally be it. So if V is the target reserve ratio, a new deposit to the banking system will increase the total amount of deposits by 1 over V times the new deposit. So our multiplier in this case is obviously like, right, this goes to, we assume this goes to infinity, we cut it off at 10 rounds, right? So this is gonna keep adding smaller and smaller amounts. And like we saw with the geometric series, and I think you can see it again in the G book, is that converges to $500. And so our multiplier, our money multiplier, we call it, is given by 1 over the reserve ratio, in the same way that we get our multiplier as like 1 over 1 minus Z, if you remember, right? Does that make sense to everybody? So that's a very important formula to remember. Delta deposits equals delta reserves divided by V. All right. So I'm gonna quickly give you some definitions of money supply. So the money supply is the total quantity of money that is in the economy at any time, right? But we've seen that money has to satisfy certain conditions, but we've also seen that there's several different things other than cash that satisfy these conditions, right? And so I'm sure you've already seen this, but I don't know why, yeah, ignore that money supply definition, right? Let's see, yeah. So we have a bunch of different kinds of deposits, right? We have checking accounts, or we have demand deposits, right, which are like your checking accounts. So that's like money, that's basically like a cash equivalent, right? You're not earning very much, little to no interest on it because you're able to just call that whenever you want, right? We have savings deposits, which are probably not, you can't access, or you're limited with your access, or you're charged a fee if you withdraw early, but they'll probably pay a higher yield, right? I think if you want, for the midterm, definitely go over this. I think it's chapter 11, 10, right? He gives you all of this, how he sort of defines the different accounts in the book, right? Term deposits, I think that would be more like a certificate of deposit in the book. So it's like a long-term savings. Basically, there's short-term bank accounts that pay little yield, and there's long-term bank accounts that pay high yields, but you can't withdraw from, right? That's kind of, it's a bit of an aside, but he did specifically ask me to go over that with you guys, right? Two commonly used measures of money in Canada today are M2 and M2 plus. We also have M1 and M1 plus, right? But this is M2. If you're just looking at M1, then you're kind of missing a huge part of the picture, right? Because as we've seen, like, deposits are money, and you need to keep track of them. M2 is the currency in circulation, so physical currency, plus demand and notice deposits at chartered banks, right? So the difference between these money supplies is like, what kind of bank accounts do they include, right? As we've seen, maybe like a demand deposit is a cash equivalent, but like something like a term deposit or like money market mutual funds aren't cash equivalents, right? Like you can't necessarily, you don't have like a money market debit card that you could go use. Like you can't use bonds to buy, you can't use savings bonds to buy bananas at the grocery store, things like that, right? Whereas like your demand deposit, yes, it's deposited in a bank, but you can just go use your debit card and pay for that like cash. So that's why we kind of want to have different definitions of the money supply to keep track of different kinds of deposits, right, and what yields they're earning. So M2 is currency plus demand and notice deposits at the chartered banks. M2 plus is M2 plus similar deposits at other financial institutions, right? So other financial institutions like, these are maybe more common in the US, but there's financial institutions that don't necessarily take deposits, right, but just do mortgage lending maybe. There's some like credit unions, right, that aren't chartered banks but still take deposits and do loans. So, but they maybe don't have as big an impact on the economy as TD would. So that's why we sometimes group them separately into M2 plus, right? And we keep track of all of these. Your money, your substitutes. Okay, I think that's pretty much it. I don't know why. Okay, are there any questions about that process? Yes.
The question that's kind of on the quizzes that we did, they asked about, or they involved like shareholders' equity, in terms of like assets versus liabilities. And I was just wondering, I don't think I saw it in the G book, or he mentioned it, maybe I missed it.
Yeah.
I'm just wondering.
So, yeah, I mean, we have it here, right? That's what the capital means. It's just, but like, our reserve requirement is more related to deposits. That's just more like.
Like what is shareholders' equity is just capital?
So like, what does a bank do, right? It wants to, a bank makes money by lending money to other people, right?
Yeah.
It can use deposits to do that, or its shareholders, like the owners of the bank, can put their own money into that bank, right? So that's what shareholder capital is they're using $1,000 of other people's money and $100 of their own money, basically.
So equity means capital?
Equity is whatever's left over when you subtract your liabilities from your assets. And when you buy a stock of share, you're buying a percentage of that amount. So in this case, they put in $100, right? So we assume that, like they sold $100 worth of shares, so we assume that that's what the equity is, right? That it kind of has, not like a dual meaning, but like there's two sides of it, right? A buyer and a seller. So they sold a certain amount of shares in their company in exchange for $100. That's what that means.
So does capital only come from shareholders buying stocks, then the bank has the money?
Well, like not all banks, I'm not sure actually, but I don't think all chartered banks are public, right? So sometimes, yeah, it might be, like it has to be the issuance of new shares, right? Like if I have a pre-existing share of TD and I sell it to you, they haven't received any money from that transaction, right?
Right.
They only get money when they issue brand new shares and sell them. So, or like, so that's what that is, that's what that represents, is they've originally issued a certain amount of shares and received that amount in return. Usually what that means is one of like the founders or maybe like an executive has said, I'll give you $100 in exchange for becoming a part owner of this bank, right? That's what that means. So modern banking regulation takes the form of requiring this to be a certain percentage of loans, right? Basically meaning like, you can't just gamble with other people's money, you have to put like 20% of your own money in this if you want to take risky loans. So you have to share in people's losses, right? Anyway, that's money in banking. I know we've gone through a lot, but I do want to quickly run through a bond pricing example. I'm just going to do a simple one, just because I had so many questions about it, and present value is a pretty important concept. That was super quick. Okay. Sorry, guys. All right. Who can tell me what a bond is? Who can give me a definition of what a bond is? Anybody?
It's like a loan between a company and a person or the government, where the government's like, hey, I'll give you $100, or you give me $100 now and I can use that money and I'll give you more later.
Yeah, it's a loan between two parties, right? Sometimes it's the government and households, sometimes it's the government and firms, sometimes it's firms and households, sometimes it's just two individuals, right? That's what a bond is. It's a standardized loan agreement between a borrower and a lender, right? We have a bunch of different names for borrowers and lenders, so like, The borrower is sometimes called the issuer, right? It's also called the short position, right? And then the lender, we call the holder, right? The bond holder, or it's the long position, right? We're usually gonna use, this is like more of a finance term, but so like you've probably seen it maybe in movies like The Big Short or whatever, that's what that means, right? It's one, short and long is telling you on which party you are in a financial agreement, right? So, I'm just gonna jump right into an example because I feel like if I explain the characteristics of a bond without an example, it just makes no sense. So let's say some guy comes to you on the street, maybe he's dressed like me and he looks really rich, right? He says, I've got a fantastic deal for you. I'm gonna offer you a 1-year bond with a face value of $1,000, basically saying I want to borrow $1,000 from you, and I'm going to give you a coupon rate of 5%, right? What that means, what he's proposing to you is that right now at T0, you pay him the price, right? We'll call it PV for no particular reason right now. You're going to pay him, he's going to receive this amount from you, right? And then, so if you're the, we'll call it the holder. So if you're the holder, right, you're paying that amount, he's receiving that amount, at T equals 0, right? And then in a year from now, which we'll call T equals 1, he's gonna pay you 1,000, the full face value, plus 5%, which comes out to $1,050, right? Does that make sense to everybody? This is what it means if somebody offers you a 1-year bond with a 5% coupon rate. Usually it's implied that the face value is $1,000 in bonds. Yeah?
So PV is 1,000?
Don't worry about PV for now, we're gonna talk about it. PV is, you have to ask yourself, what would you be willing to pay to enter this agreement? What would you be willing to pay to receive $1,000 and $1,050 in a year's time? He's telling you he wants $1,000, right? Let's say, and he's saying he's gonna give you a 5% coupon rate, and let's say you decide, for no particular reason, whatever I give him, I wanna earn a 5% return on my money, right? Let's say you decide, we'll call it I, right? We'll say, let's say you want to earn a net return of 5% on this investment, meaning you're gonna have to just take that into account when you decide how much to pay, right? So basically what you're saying is, you want what you receive in the future divided by what you pay now to -1, right, to be equal to 0.05. Does that make sense? So by choosing, you've decided in your head that you want 5%, so that means you have to choose a price, right? When you choose a price for a bond, you're implicitly choosing a rate of return for yourself as well, right? Because you know how much you're gonna get in the future. It's a fixed income security. And then we can solve this, right? We can isolate PV here to get so basically, and then what is this? I think I wrote it down. Oh yeah, I mean obviously it should be $1,000. This just happens to be $1,000, right? So in this case, you say I want to earn 5%, and you're going to give me $1,050 in a year. So you do the math and you say, okay, well, I can achieve that return if I pay you what you're asking for, which is $1,000, right? So that's great. You're like, I'll pay you $1,000 and I'll get my 5%. Does that make sense to everybody? So that's where this formula comes from, right? For a 1-year loan, we have more generally, right? The present value or the price of the bond is equal to the future value, which is the payment you receive in a year, divided by 1 plus your required rate of return. So that's an important formula to remember, and that's why, right? Because when you're choosing your price, you're implicitly choosing a rate of return through this relationship, right? So, now this happens to equal $1,000, right? This guy came to you and asked to borrow $1,000, and that happened to line up perfectly with the rate of return you were looking for, right? Maybe you go look at the market, you look at some other investment opportunities, and you come across some that pay a little better, and you're like, you know what? Instead of, so we know that when I equals 5%, right, the PV is $1,000, right? let's say you actually go look at the market, you say, oh, there's a lot of investments right now that are paying 6%. So I'm actually gonna say I want 6% on this investment, right? What does that mean? Are you gonna be willing to pay more or less than $1,000 to enter this agreement if you require a rate of return that's higher than the coupon rate? Think of it, right? You could get 6% elsewhere, but this guy's offering you 5%. So you're gonna pay more or less than what he wants? Less, right? How much less is determined by the present value formula, right? Mathematically, when you decrease I, or when you increase I, the present value is gonna go down, right? So I did this example earlier, and I did not write down the quantities, so I'm just gonna have to do them real quick. So our present value formula comes out to so if you go around and look and say, hey, there's some better deals I could get, you're like, hey, I'm not gonna lend you $1,000 to enter this agreement, but I'll lend you $990.57 because I want a 6% return and you're offering me 5%. Does that make sense? So that's how, so when our required rate of return, we call this required rate of return or market interest rate because we assume that your required rate of return is based on what you observe in the market, right? If you're asking more than people are willing to give you, then you're not gonna find any investment opportunities, right? And if you're loaning money at a lower rate for no reason, then you're crazy, we assume, right? You're just foregoing money for no reason. So when this moves above the coupon rate, the present value drops below the face value, right? And then if maybe you look elsewhere and say, oh, this is actually a pretty good deal because everything else right now is only paying 4%. Then our PV is going to be greater than $1,000, right? And it's going to be $1,009.62, right? So does this make sense to everybody? You should see the relationship right between bond interest rates and bond prices, right? We're talking about a bond here. This is how all assets are priced, physical or financial. A company who wants to invest in something like a bulldozer or a conveyor belt is going to say, how much money is this going to save us over the course of the next few years, right? Maybe they're looking at buying a new machine for their factory that's going to save them $2,000 over the course of the next year. They're going to look at interest rates and they're going to price that exactly how they price a bond, right? When the central bank lowers interest rates, right, all assets suddenly become more valuable, right, just because of that future value principle, right? Any cash flow generating asset, right, whether it be financial or physical. When they increase interest rates, right, asset values decrease because of this principle. Does that make sense to everybody? So when you see that balance sheet on the Bank of Canada, right, you can kind of think of what they were doing at the time, right? When they're lowering interest rates, which is what they were doing at the beginning of the pandemic, right? The market value of their debt skyrockets, right? And then when they start raising interest rates, regardless of what's happening with the actual payments, right? The payment schedule remains the same, but the actual intrinsic value of that bond goes down when we change interest rates. But it's useful to remember, right, that when I is equal to the coupon rate, then it's going to be equal to the price is the face value, right? When I is greater than the coupon rate, our price is lower than the face value, and then vice versa, right? That's going to be something that you'll probably be asked about. I think I'm going to leave it here. I did have another example, but maybe I'll go over it next week because it's going to take me too long. So I'll stick around for another 5 minutes if you guys have questions, but otherwise, happy to help. Yeah.
Just that any physical asset also follows that trend, right?
Yeah.
So how would my bulldozer change in value if the national interest rate goes up?
Well, it becomes difficult, right? Because like you're looking at it from the point of you have to differentiate between like when you're originally going to buy this bulldozer or you like trying to resell it and you own it, right? So like just practically, if you're trying to buy a bulldozer, you're probably gonna have to borrow money to make that happen, right? So you're going to be doing this, like the interest rate is gonna make that easier or higher, right? So just like intuitively, if there's low interest rates, kind of like mortgages, right? People are gonna be able to go buy more money to finance bulldozers, so the price will go up, right? But we assume that people think of it practically, right? They're like, okay, this bulldozer is gonna allow me to do $50,000 a year of new projects per year, right? And then they're gonna evaluate it in a similar way. They're gonna look like, I could put my money into that bulldozer, or I could put it into a bank account that earns 4%. So if I'm gonna buy this bulldozer, I better get at least 4% of my money. That's kind of what they're saying, right?
Yeah.
Any other questions? All right, well, I'm here till 4:50, so.